All right, just to remind you, we are completely updated on YouTube. So I haven't done the official count, but I think we got somewhere in the neighborhood of around 700 videos that we have available to you guys 24/7 to watch, and that is completely updated. So don't forget that that resources is there for you. Today we have two very special guests. Excuse me, from Shelter Home Mortgage. We have Kathy and Alec. So what I have in mind for today, guys, is I kind of told you that we would do like a Q&A, and I do certainly want to reserve some time for that. But I'm hopeful that you guys can do one extra thing for me, which is if I were to say, hey, break down speak to somebody who doesn't know anything about loans, or maybe has like a tiny little bit of knowledge about loans, and tell them in, let's say, 5 minutes, what should somebody know about an FHA loan? What should somebody know about a VA loan? What should somebody know about a conventional loan? And then I'd like to go through those three in particular. Then I'd like for you to take a couple of minutes to explain some of the things that you do perhaps a little differently than most lenders do. Like I know you guys can do, for example, like a full underwrite so that you can remove things like a financing contingency and these kind of things. So I'd love for you to have a platform to share what you do differently. And then I'd love to open the floor to some Q&A. Does that sound doable?
Yeah, that sounds good.
Okay, perfect. So the room today is, we got a couple of agents that have been around for a little while, but primarily we're looking at people that have been in the business, let's say about a year and a half or less. And so that's kind of the kind of complexity that I'd like you to use when you're explaining these things. So and also if you could just share a small introduction. I'll start with Kathy. I've known Kathy since I've known Kathy's husband since I was probably 10 years old. I used to study karate. I was a black belt, or am a black belt, I suppose. Don't ask me to do any kicks or anything. But I do have a black belt, and I studied under Kathy's father in the very early late 80s.
Husband, not father.
Well, no, husband. I'm sorry. Did I say father? I studied with Keith, Kathy's husband.
He's old, but not that old.
If everyone wants to report their numbers by 10 o'clock, then I'll send you a picture of me doing like a really cool kick when I was like 9.
That'd be cool.
Right. I even got a smile out of you, Markia. All right. So Kathy's been in the business a long time. We've known each other here at KW for over 11 years now, and you've always been a confidant of mine and a friend of mine, and have helped me personally and a handful of my clients, with loans. And Alec and I have just gotten to know each other here in the last year or so as you've been here. So I just appreciate. I want to publicly thank you for all that you do for the office, with your time and with your money. And many of those things are, in my opinion, kind of happen behind closed doors, and no one knows about it. But I'm here to tell you that there's not a whole lot of people that care more about you and your success than Kathy and her team. So I just want to publicly thank you for all of the efforts that you put out for us. Okay, so tell us a little bit about yourself, and then let's start with the FHA loan.
All right. So as Bill said, I've actually been at the office, the Keller office there, as the alliance partner for 14 years, almost 15, 38 years in the business. And Alec joined my team. Actually, was it 2.5 years ago when you joined, Gemma? Yeah. So straight out of college, joined the team, and we inducted him into the world of mortgages as fast as we could. He's done just an incredible job in doing that. I am married to Keith. Bill's, like he said, his instructor, not my dad. And
that was a total mistake. I
know. And we have a blended family of 2 girls, one's in their late 30s, a son in his mid 30s, a grandson that's 12, and a granddaughter that in February will be 5. And we live here. Our kids live here. Well, our son just moved to Florida. Actually, Travis Vitale, y'all may have known him in the office. Him and his fiance moved to Florida, so they're down below Tampa. And then Alec, go ahead, tell them a little bit about you.
Yeah, hey guys. So like Kathy said, I'm Alec. I've been with Shelter for I think going on 3 years, but with Kathy's team for just over 2 years. I was split between the Roswell and North Atlanta office, and then Kathy got jealous and stole me over to Roswell full time. So I've gotten to be a part of her team for going on a little over 2 years. But I went to Berry College, like Kathy said, I'm straight out of school, jumped into Shelter, and have been loving it. And definitely grateful to be in the Roswell office. I'm married as well. Been married for 14 months. My wife Jordan, to my wife Jordan. So we're just really enjoying it. We're buying it. We're in the process of buying a house right now. So that should be finished up here in the middle of December. So we're really excited about that. But grateful to be on today. Thanks for offering this up, Bill. I'm excited to share this with you guys.
Beautiful. So let me give you just a tiny bit of background. The goal of today is not to help you become a perfect expert in the world of mortgages. We want you to have maybe a little bit more than a baseline knowledge, so that you can have an intelligent conversation with your prospects. But just like anything, like if you've got a relationship with a termite guy or a roofer or something like that, like you have a good enough understanding of the industry and the products, et cetera. But then as soon as it's time for the expert, then you connect them with the expert. And so you want to have a general idea of how to, write an offer with a conventional loan or write an offer with an FHA loan, but you don't have to underwrite the file for them. That's Kathy and Alec's job. So let's say you're on the clock, you got 5 minutes. Tell us about FHA loans. What do we need to know about FHA loans?
Go ahead, Alec. You can start with FHA.
Gotcha. Yeah. So FHA loans are obviously a government-backed loan, and so because they're going to be a little bit stricter with the guidelines in some respect, and in some others that they're a little more lenient. For example, so the minimum credit score that we can use with an FHA loan is a 580. Which is a little lower than what I've seen from other lenders and other banks out there. That doesn't mean if you have a 580 credit score that you will qualify for that loan. It just means that it is, before, during COVID, it was 620. Now it's 500, so for 580. So it looks at a lot of different factors. One of those being the credit score. So we are able to go a little bit lower in credit score with FHA. You can put a minimum of 3.5% down on an FHA loan. And there's also going to be a mortgage insurance premium, 2 sets of mortgage insurance on the FHA loan, and it is attached to that loan for the entirety of the loan period, 15, 20, 30 years, whatever it might be. And so you typically will have a little bit lower rate with FHA. Again, it is credit score driven. So that can help out with the payment, potentially, the closing costs. Really the payment and closing costs, and Kathy, you can speak on this a little bit. I've seen are being, are very similar to a conventional loan right now because of how low the rates have been. But they might vary just a little bit. And that's just kind of a quick, a quick just overview of it. Kathy?
The only other thing I'd add is on an FHA loan, we can do manual underwrite. I've got a gentleman that I just closed last month. He had some previous bad credit. His score was in the 590s, but he had a couple of things on his credit that was erroneous that he just couldn't get off. But he had the documentation to prove it. So we went to the underwriter and said, hey, we need a manual underwrite. He's got this house. He's going to lose his house if he waits to get this stuff on his credit report straight. We've got the documentation. We just can't get the bureaus to get it off fast enough. So we did a manual underwrite. Now that does lower the debt ratios. The other thing about FHA, and believe it or not, I mean, we can be in the 50s on debt to income ratios. So of their gross monthly income, taking their car payment, credit card payments, student loan payments. Student loan payments is a whole calculation that we have to do also. all of that in consideration, we can go not net income off their gross income in the 50s. And you can't do that on a conventional loan. It just
I mean,
won't let
Kathy,
it.
we've seen up in the 58, 59s. I mean,
Yeah,
you
I'm
really
talking
can push
almost
it up there.
60, almost 60% of their gross income. And all of it, the automated system that rates all of these loans makes that decision. It's going to look at that credit. It's going to look at the credit score. It's going to look at, you know, the income to debt ratio, but it's also going to consider, do they have any savings? Do they have anything in 401k? You can get into a house without any savings at all. You can get into a house with an FHA loan and a conventional loan and a VA loan without any money left over. You don't have to have it, but when the automated system underwrites it, if you do have it, which is called reserves, left over, money you're not spending, you can 401k, you know, just to say plain savings plan, it does help. It helps. And the automated underwriting system, again, unless we go manual underwrite with FHA, is what every lender uses, is the same thing.
Yeah, and also with FHA, I had a borrower, I think it was last week, 584 credit score, a bankruptcy 3 years ago. There's no shot they're going conventional, but we were able to approve them FHA. So, you know, that's a scenario where, you know, FHA might be a little more lenient. They allow for Chapter 7, I believe it's 2 years from the date that it is dismissed, not filed, but dismissed. So, you know, it's just something to look at, Bill. And I know you mentioned wanting to talk about some of the things we offer, and Fast Track kind of plays into FHA because we're doing most of, if not all of our Fast Tracks right now are FHA or VA loans. And Fast Track, we're just able to put them through full underwriting, not just the pre-approval, but full underwriting. So for that borrower who is at a 584 with the bankruptcy, you know, has a little bit of some quirks in their file, we're going to send them through underwriting. It takes about a week, but we have that back. They're fully underwritten, good as cash. Now they're competing with those cash offers as conventional loans.
And our underwriters are local guys. We've got a hub out of Norcross, and they're all working still remotely and are choosing to, which I don't blame them. But we can get them on the phone, you know, and usually instead of some of the banks or other lenders you might work with, it may be we can't get an answer from an underwriter until 48 hours or more. We can usually get it that day. So if it's something corpy, we're going to get it, send it over to them, something that we're just not 100% sure about, and let them sign off on it and go, yeah, you're good. Or, you know, this is the paperwork I want around it. So, you know, we can talk to someone, get their scenario, run it by the underwriter, and them say, hey, it sounds like it'll work. And hold on a second, sorry. It sounds like it would work. Get the paperwork and let me look at it. So you don't have to pull credit. We don't have to pull credit to have these conversations. We can talk through that scenario and give them, you know, hope once we can pull it and look at the documentation around it.
All right, so controversial question here. If somebody is getting an FHA loan, if we've got a listing, offer comes in, it's with an FHA loan. Should we assume anything, or should we assume one of two things? It's either got some stuff that needs to be resolved or some tricky stuff in the past, or they're looking just to pay less in the form of a down payment?
It can be any of that. It could be their debt to income ratio is high. It could be they only want to put 3.5% down and their credit score dictated that it's a better rate for them, FHA versus conventional. It could be so many different layers. There's just different caveats, you know, like Alex said, you know, 2 years out of Chapter 7, 3 years out of foreclosure. You know, if they've had those kind of situations, short sales, then FHA is going to be the more lenient way. And it's not that it's not a good loan. And that's the key. When you put a listing, put an offer in, we're going to call that listing agent and we're going to solidify that we're local. We've already underwritten them. They're an excellent loan. Our FHA appraisers are our conventional appraisers. It's no different appraisal. The one stick that some listing agents have is you get an FHA appraisal, it sticks with that house for 6 months. If someone else goes FHA, if the next person goes conventional, it doesn't stick with it. It's not attached to it. So sometimes there is a pullback from agents because of that, because of the FHA, but they really don't understand. And we can get FHA appraisals in 7 days or less. We can let them know very, very quickly if there's going to be a concern or not. And we're putting that in the contracts too. So when you pre-underwrite, when we do the fast track, no financing contingency on your offer. 0.
How long does it
Don't have
take
to-
to fast track it?
Fast track, like Alex said, is usually a 5-day window once we have everything.
Which could be done prior to them even looking at homes, certainly.
Oh,
prior
yeah,
to
they
making an offer.
pre-qualify. Okay, so we're pre-qualified. We've talked to them on the phone. We've pulled their credit. We've got their scenario, and now we've asked them for documents. They give us the documents. We've pre-approved them and put them into fast track. And a lot of times, if they're salary, no deposits that are weird on their bank statement, we don't need to fast track them. I can look at it. Alec can look at it. We run automated underwriting, certified. No underwriter needs to look at it. But if it's got a different layer, we want to go ahead and get that underwriter to sign off on it. And that's when we fast track it.
Okay, beautiful. Just a tiny bit more detail, Alec, in the 2 forms of mortgage insurance. Can you explain that in a little bit more detail, please?
Yeah, so you have the upfront mortgage insurance attached with the FHA loan. That can either be financed back into the loan or paid in full at closing. 99, I've never done a deal, and Kathy, maybe you've done a handful that have paid it at closing. Most everyone just rolls it back into the loan amount. So you have the upfront mortgage insurance and then the mortgage insurance premium, the normal MI attached with the loan. And obviously that is going to be dictated off of down payment, credit score, a handful of factors that will dictate what that mortgage insurance amount is on the monthly payment. And so really, and again, it's, I believe it's, Kathy, is it 1.75%? Is that the mortgage insurance premium attached to most of these loans?
Yep. And actually on an FHA loan, which is very rare, if they put 10% or down more, the mortgage insurance will remove in 10 years. So that's one thing that we always forget about because most people don't ever do it, but it can come off, but that's the only reason. Back in the old days, back in the past, it was like a conventional loan. Eventually you could get it off when you had a high appraisal, but they stopped that.
It's 10 years or 78% loan to value.
Right.
Yeah.
Okay, cool. So you have the upfront mortgage insurance, which is rolled into the mortgage, generally speaking, and then you have a monthly, which certain circumstances later on could remove with equity build.
10% down up front.
Yeah. Okay. But if it's 3.5% down up front, that's staying with them forever.
The life of the loan.
Yeah. I remember the olden days, that wasn't always the case.
Exactly. And it used to be assumable. FHA loans used to be assumable, non-qualifying.
Yeah.
Not anymore.
But the same person that can only put 3.5% down is not going to be able to buy out the equity of the guy anyway, probably.
Exactly.
Yeah. All right, cool. 5 minutes. Conventional loans.
Conventional loans, you can put as little as 3% down, whether you're a first-time home buyer or not. Actually, there are some companies, we're not doing it, that have 100%. So some of the banks are starting to put that program out there. It's 100% financing for first-time home buyers. It is normally fixed rate. They could get an adjustable rate with 10% down, but most people aren't doing that. No prepayment penalty, just like FHA. The debt to income ratio is not going to get into those high 50s. It's going to get into the high 40s. For most people, it may even be in the mid to low 40s of their gross income. There is mortgage insurance and there is not mortgage insurance. So they can have the standard program where the mortgage insurance is monthly. After 2 years, if they have enough appreciation in the house and they paid perfectly, they can request on a Fannie Mae or Freddie Mac service loan to get a new appraisal and get that PMI released. So some people choose to have PMI monthly, knowing, especially with the escalation of value that we have locally right now, that maybe in 2 years, they may not have to have private mortgage insurance. You can actually take the private mortgage insurance and you can actually put it in the rate. We can finance it in, lender pay it. So we can raise the rate about a quarter and it's in the rate, so it's not monthly. Someone would do that if they don't think that they're even going to worry about trying to get it off in 2 years. They're going to keep the house 4 or 5 years and they just want that payment. The PMI is not deductible on taxes if you make over 100,000 a year. So if you make less than 100,000 a year, the PMI monthly is deductible, just like interest on a mortgage. So that's one factor that we talk about too, of why you may or may not want mortgage insurance, depending on your financial situation. We can still do manual underwrite. We can override certain situations. I haven't done it, but we can do it on a conventional loan also. The minimum credit score for us is 620. I think that's standard with Fannie and Freddie. I don't think the industry has any lower than 620. And when we talk about 620, that's their mid score. So everyone on the loan has 3 credit scores. We have to have their 3 credit scores: TransUnion, Equifax, and Experian. We take the highest score and the lowest score, and those are dropped. We use the mid score. So one borrower may trump the other borrower with a lower score. Sometimes we even take off a borrower because their score pulls everything down and gives them a worse rate. The better the score, the better the rate on all the loans. Also on conventional, the better the PMI. So debt to income ratio, credit score, all really does matter on a conventional loan. Appraisals don't flow like FHA with the next borrower. So if they're under contract, it blows up, the appraisal didn't appraise, the next conventional loan customer comes in with a different company, orders a brand new appraisal to see if it'll work.
Okay. Now with conventional loan, can you talk, well, actually, let's talk about closing costs for a second, because in particular with this market, closing costs are relatively rare for the seller to pay. And
Right.
one thing that I've recommended in the past as just a possible solution for these buyers is, for example, let's say they are getting a loan for $350,000 and the closing costs are 10 grand. And the seller is not interested in paying the closing cost, or they're not willing to pay all of the closing cost. And the buyer is basically just, they're using all their money for a down payment, let's say. Aren't they able to potentially roll the, increase the rate just like you would with PMI to offset closing costs? Can you walk us through what that is all about?
Yeah, you can do that. It's called premium pricing. It's a little hard to do in our market because the pricing on the rate is not as advantageous to do that. So a lot of companies advertise they're a no origination fee company. That's what we are. You don't have to pay an origination fee to get a loan with us. You don't have to pay discount points to buy the rate down. We can do it without any of that. Keller Mortgage advertises that. Gary's big advertising is that they save people $4,000 or $5,000 on a $300,000 loan. And it's a great marketing ploy. The bottom line is they have no origination fee. So he counts on a $300,000 loan, that's saving them $3,000 compared to what a broker, a Quicken Loan may charge. And they pay $1,000 in closing costs. The way they pay $1,000 in closing costs is the same as we can do. You raise the rate a little bit. So you've got premium in the rate. So if someone calls us and say, hey, we're seeing 3% rates out there, we can do 3%. Let's look at the cost associated with it. Then let's look at the cost associated with 3 1/8. Then let's look at the cost associated with 3 1/4, 3 3/8, 3 1/2. We show them the difference in the payment. We show them what they can get. Again, like Bill said, we can pay closing costs at 3 1/2, maybe the majority of them. The difference in the payment and 3 1/2 and 3%, where 3%, they may have to pay an extra $3,000 in closing costs to get that rate because they're paying discount points to buy it down. So it's all the rate and the cost. Nothing's free. The rate and the cost are all associated. And yes, if we've got a buyer, which I just had one, FHA, they don't have enough money, seller won't pay anything, they don't think the house can appraise higher. We raised the rate a quarter. I was able to pay $2,000 toward closing costs or more. I think it's $2,800, and it pulled the gap together.
Okay, so
we
let's
can
summarize.
do that on any loan.
All right, let's summarize. If your buyer is just out of money and they need closing cost, you can talk to Kathy and her team or any lender to say, hey, could we raise the rate, and how high could we raise the rate to offset these closing costs? Because it's important, like, don't allow your buyer just to choose the lender based on rate. Like Kathy was saying, we can give you a 0.5% rate if you want. You're just going to pay $25,000 in closing cost, right? So, or more. So the question is not what is the rate? The question is what is the combination of rate and costs? Is
It's
that correct?
APR. What you want to know is the annual percentage rate. So they're going to always get a rate, which is the rate they'll have over the life of the loan, and they're going to get an annual percentage rate. The higher the annual percentage rate away from the rate is, you know that they're paying closing costs. You know that they're paying extra to buy it down. Normally, with no points, no origination, just standard lender costs, the rate and the APR should be very, very close. I just had a situation with a very experienced agent. She tried her best to get her client to talk to me, wouldn't do it, using my best friend to do my closing, wouldn't think about anybody else. She got to see the closing statement, the rate and the points. Best friend made some money off his best friend. It was really bad. So you just never know. I mean, you know, how people quote and what their justification is. But a lot of times, you know, the APR is the key. It is just a good question to ask. If they say, well, I don't know what the APR is, well, then they don't know what they're paying for the rate.
Right. So in general, do you, once you gather all the information and you know how much cash they have available, you know what their ratios are, you know what their down payment options are, you're the one that basically goes in and kind of comes up with the most cost-effective way to get the loan, and then you share that with the borrower?
Yeah, the plan. And Bill, we, you know, just as we said before, Alec and I and Tammy are here not only as mortgage originators like everyone else, 100% commission like y'all, trying to get everybody we can to do business with us, but as an alliance partner and to be, you know, the person that I want to be in life. If it's a program that we don't have, just like we said, Regions has 100% financing. If I've got someone that we're qualifying for you guys and they could buy now with every other factor but that down payment, I'm going to talk to you about talking to them about Regions. Alec is going to do the same thing. You know what? If they just can't buy because of that one reason, maybe they need to look at that bank program and they can go ahead and possibly buy. It's a conventional loan, 100% financing. You know, it may be exactly what works for them. And we're going to let you know that. We don't do rehab loans right now. I've got someone that I'd connect you to on a rehab, on a construction perm. Georgia Dream. We do rural housing. We do the FHA and the VA, but we're here for you and your client to say, okay, we don't have it, but we kind of know somebody that we're, you know, in the industry that can do it and get them a house now. We're going to help you with that.
Okay, VA loans. What does somebody need to know about a VA loan?
VA is 100% financing for the veteran. It's an amazing option, even if they have money down. It's a lower rate. I mean, Alec and I quoted, you know, when we quoted, the conventional and the FHA rates are higher than VA. If a veteran has any disability income from VA at all, I don't care if it's $100 a month, they don't have a VA funding fee. So there's no PMI like a conventional loan. There's no MIP.
Hold on. VA
Okay.
funding fee is the kind of the
Is
VA's
the government
version.
insurance, the MIP, the conventional PMI. So the VA funding fee is attached and financed in if the veteran doesn't have any VA disability income. If they have VA disability income, they're getting 100% financing, no PMI, MIP, or VA funding fee at a lower rate. It's just an excellent, excellent program.
And
even
what are
if they have money, they should do the 100% financing most of the time. We have veterans that put 20% down and they still go VA because they get a better rate.
Okay, so what would you say are some of the maybe drawbacks or disadvantages of a VA loan?
The listing agent, if they have it in their brain, is worried about the VA appraisal. But this is what I tell them. Again, Alec and I call the listing agent and we sell the fact that the veteran should have the right to have the offer on this house. The VA appraisers are conventional appraisers and FHA appraisers. They're just guys, just like all of our other appraisers. It is a VA panel. They are looking for the priority is to keep this, make sure this house is safe for the veteran. But on FHA and conventional loan, those appraisers are doing the same thing. If they see holes that are leaking in the ceiling and active mold, every appraiser is going to have to note that. They can't ignore it. In the VA panel in the past, if it's an agent that's been in the business a long time, the VA panel wasn't known to be as good with getting the value there. And I explained to them, because again, I've done this for 38 years, most of those guys have died. They're not on the panel anymore. So a lot of these appraisers are young, professionals that are doing a good appraisal. We're not having low appraisals. We haven't seen any VA appraisals that are low this year at all.
Interesting. Okay. Okay, let's do a little bit of summary of what makes you guys different. What do you guys do that's different outside of one thing, which I hope people just might hear this and think that everyone does it, but the fact that you guys take the time, number one, to really study the borrower's profile to, try to make certain that they're paying the lowest rate possible, not just the most money in commissions, right? And that they have the best package based on their current needs and their potential future needs. So that is rare as it is. You might think that's not rare, but it is. And then to take the time to call the listing agents to vouch for the borrower's offer, the buyer's offer, is also something that I would say is incredibly rare in this business. So other than those two things, what would you say? What does Shelter do, or what do you guys do that is unique?
Alec, you could run with it. I actually have a leadership call that started at 9. So I'm going to let Alec tie it up.
Thank you, Kathy.
Thank you, guys.
Yeah, so we've talked about a lot of stuff, in brief, but the one thing Kathy might have skimmed over is waiving of appraisals. So that's going to be on your conventional loan. So, and I was talking about this in Chris Manlisic's class yesterday. We have agents who call us and like, yeah, we didn't want to bug you on the weekend. We just submitted the offer. Our thing is, no, we want you to bug us because we want to be able, if you're putting 20% down or more, if your borrower is putting down 20% or more, we want to run that address in our system, in our desktop underwriting system. And what it's doing is it is looking at the offer price and the combination of the loan scenario, and it's comparing it with comps that have sold in that area in the last 2, 3, 4, 5, 6 months. And it's justifying the value that you're offering. And if it feels like it is justified at a fair value, it's going to waive the appraisal. So now you're potentially waiving financing contingency, waiving appraisal contingency. At that point, you're as good as cash. So that's something that we're doing. We're waiving those appraisals. Also, for a W-2 salary clean borrower, we're waiving financing as well. Like Kathy said, we're local underwriting, local appraisers. We can call our underwriter and get her on the phone and ask her questions. That is very, very rare for a mortgage company. And so we're able to do that. As well. Like Bill mentioned, we're doing the full pre-qualification consultation up front. We're getting your borrowers on the phone. We're running through their whole application. We're looking at scenarios. Like Kathy said, we're not just trying to pre-approve them, but we're trying to give them the most cost-effective scenario for their situation. So we're really, like Bill said, we're studying that borrower, their situation, to see what's going to be the best fit. And Bill, we kind of, we did conventional FHA, VA. I just really quickly want to touch on USDA. That one's kind of flying under the radar right now, but it is a awesome 100% financing loan. I had a borrower that was, I don't know if I'm gonna be able to remember the area, but West Georgia, kind of out further away. He's a professor at West Georgia University. He fell in the area that is considered USDA. He'll be able to do 100% financing potentially. And it's again 100% down program, good rate, no first-time home buyer. That doesn't disqualify you from this loan. So that is another thing. If you do have a borrower who's getting kind of out further away, from Metro Atlanta, then we'll see if they can go USDA and do that 100%.
Is there a map that you could share with me that would indicate where the boundaries are?
Yeah, there's an eligibility map. There are there's an eligibility map. You just type in the address, it'll throw it on the map. It'll either be in red or green, and it'll let you know. I believe there are income limits, and for USDA, the important thing to note there is that it is the entire household income. If you have a mom and dad and an 18-year-old child who's working at a car wash part-time, we have to consider that income as the household family income for qualification. But that's something we'll do in that that consultation up front as well. But yeah, Bill, there's a map. I'll send it to you when I get a second, and you can share that as well.
Okay, so let's summarize a couple of points. You guys remember there's generally 3 contingencies when you submit an offer. There's the due diligence period, right? What we used to see was that was anywhere from about 10 to 12 days or so, maybe up to 14 days. Now we're seeing that more like 3 to 5 or maybe 7 if you're lucky days. The main thing that you need to be considering there is, can you get the inspector out, and can you do any of the other tests that you need to do, whether it be termites or radon or septic or any of that kind of stuff? Is there enough time to physically get it done? Okay, the other 2 contingencies are related to the loan. What we used to see is the financing and appraisal contingency would be somewhere between 21 and 25 days. Now you're probably more like 10 to 15 days, again, if you're lucky. However, if you have roughly 5 days, you can send the person through your fast track program, which if they come out of that okay, then you don't necessarily even need a financing contingency, because the shelter is basically saying, hey, these guys are good to go. Is that correct?
Correct. Yeah, we're able to, like you said, run it through that fast track program, build it into that due diligence, and then that way we can give the thumbs up, which would be, hey, waive that financing contingency, or the, hey, we need the full 14 days or the 10 days to really vet this person. So yeah, we're able to run them through a fast track.
Okay, you said slightly different words than I did, so I just want to confirm again.
Okay.
If I've got a borrower and they got a clean file and I send them to you, 5 days later, you can tell me they're good and I don't need a financing contingent, or they don't need a financing contingency. Is that correct?
Correct. And that is assuming that there is something that we need to double check, to have an underwriter look at, to have them fully under. And if they're a W-2 salary, good credit score, have assets, good income, we're not going to put them through fast track. We don't need to. Kathy and I can look at it and just say, hey, they're good, let's waive financing. But for that person who, hey, this is a little quirky, yeah, we can do it, just like you mentioned, build it into that 5 years.
So that conversation at the buyer consultation sounds something like this. One of the benefits of working with myself and my team, which includes the folks over at Shelter, is if you're cooperative with getting all your documentation into the lender, not only will they take the time to analyze your file and make sure that you're getting the best package possible, but 5 days later at the most, they're going to report back to us, hey, this guy is good and doesn't need a financing contingency. Now, let me tell you why that's important. Because if we are in a competition with multiple offers and the other offers either don't take that step or don't know any better or aren't working with a lending team that can do this kind of thing, then they stick a financing contingency in there, and well, you don't have one and you look better. Yes? Okay,
Correct.
Next, appraisals. So there's 2 ways to deal with the appraisal contingency. The first is you put it through the system to see if an appraisal is even necessary in the first place. Yes?
Yep.
Okay, the second, and of course, if it's not necessary, you don't need an appraisal contingency, right?
Correct.
The other way to deal with it is to say, hey, go ahead and order the appraisal immediately once we go under contract, and the turn time for that is what? Fast as you can do it reliably.
7 days.
Okay, so seven calendar days, right?
Yep, 7 calendar days. So if we can, get that ordered as soon as you go binding, get that appraisal ordered. The risk there is your borrower pays $475 for an appraisal. And then in due diligence, the inspection blows up and they lost $475. But in this market, to be able to waive the appraisal, that, $475 or potentially, getting that home, it's worth it. And we're doing it pretty often where we're building that appraisal into the due diligence period. But 7 days, we had one that we got back in 5 days, but it was like nick of time. So we like to say 7 calendar days.
Okay, so let me restate what that means for a second. So basically what we're saying is, number one, you send them the address, see if it's even necessary in the first place.
And that's with 20% down.
20% down. So that 20% down, and the fact that the algorithm tells you it's cool, right?
Correct.
And the turn time on that is what? A couple hours?
Oh, I mean, if you send me the address, I can do it in 5 minutes.
Okay, cool. So that's the first step. If you got a 20% borrower, run it through that system to see if an appraisal is necessary at all. Obviously, if the appraisal's not necessary, then the appraisal contingency is not necessary, right? And that allows you to stand out from the other potential offers at play, okay? Or that the seller may be considering at the same time. If that's not the case, then what Alec is saying is he can get the appraisal done in 10 days, which means that you either need a 10-day appraisal contingency, or if you're able to negotiate a 10-day due diligence, then you can do it within the due diligence period and still put 0 as the appraisal days. Does that make sense? Everyone, that make complete sense? Okay, because the due diligence is for anything, right? So it could include an appraisal as long as the deadlines match up, okay? Now, if you do right to request repairs, that's with the quality of the home, or the material defects or potential material defects of the home has nothing to do with the appraisal. So if you end up negotiating away the due diligence period, you need to retain at least a 10-day appraisal contingency. Make sense? All right, turn time on closing from start to finish. What can we expect from you guys?
We can close, and again, it does depend on the borrower. It depends on the complexity of it. If we're waiving financing and waiving appraisal, we can close in 14 days. The only thing we really need to get, that we're focused on getting back is title at that point. If we do need an appraisal, then that's going to be 7 to 10 days, and then with your TRID and getting it out on time, you're probably closer to a 17-day closing. But standard is 21 days. But if we have someone say, hey, if we can put 14 days, we'll win the offer, then we'll do whatever we can do. And usually, we're reaching out to our back end team and saying, hey, is this right now with as busy, with the market right now, is this something that is something we can do? And
so
most of the time,
30 days is maybe too much.
Yeah, 30 days is in this market is definitely too much. And so, we're able to do, 21 days. We're able to do 14, depending on if we're able to waive appraisal or financing. The appraisal is the main one. If we have an appraisal that is going to put us in that 17 to 21 day window. So it just does depend, but I would say on average, it's that 17 to 21 day closing.
Okay, and remember
I got a question.
One sec. So remember, the other important fact there is that you got to ask the seller, hey, we can close within 21 days. Is that something that would be important to you, or would you prefer a different time frame? Right. So don't necessarily just throw in as low of a number as you can and think that it's impressing the seller. It may stress out the seller. Right. So reach out to the listing agent and say, hey, we got a real solid loan. The paperwork is in. They've already gone through underwriting. That's why we don't need a financing contingency. My client's putting down 20%, so we don't need an appraisal contingency because the algorithm told us we don't need one. We can close in as few as 21 days because we're trying to stand out and win this home. Is that something that would be valuable to you, or just tell us what closing date you'd like, because we want to win. Right. Okay, Kathy, what was your question?
Does that only refer to conventional loans, or is that something that can be done with FHA?
We can do that with FHA as well. VA is going to be more like 30 days because because they are not our in-house appraisers. We're a little bit at the mercy of what they're able to do. So VA is going to be 30, but yeah, FHA and conventional are going to be very similar.
Okay, thank you.
Okay, what question have I not asked you that I should have asked you?
What question have you not asked me? Let's see, we've covered a lot. Really, kind of going off the financing contingency. When you guys are filling out the conventional or FHA loan exhibit, and you've probably heard Melba say it, and you probably have heard Kathy say it, in a class if you've taken it with us. Don't just throw in stuff to get the offer in. Give us a call and say, hey, what's the rate? What's the down payment? You're going to want to put Shelter Home Mortgage, Alec Jones, Kathy Vitale there. You're not just going to want to put 3 different lenders. You're going to want to be accurate on.
Don't put anything. Don't put anything. Let me. I don't mean to cut you off.
No, go ahead.
From a strategic standpoint, you want to leave that box blank. You can send over the pre-approval letter indicating that that the borrower has spoken to Shelter and has an approval letter. But from a strategic standpoint and negotiation standpoint, you want to leave that blank, because if by chance they choose to work with a different lender, then they ultimately have to get the rejection letter from the first lender, which is going to be a mess. So that little block that seems to insinuate to put who is going to be the lender, leave that blank.
Yep. Sounds good. But to finish that off, just reaching out to us before you're making these offers and let us run the appraisal. Let us make sure that that the loan exhibit is filled out correctly. Anything that we're able to do, let us know. Hey, we're submitting this offer. Let's get on the phone. Let's talk through it. That way we know, hey, we'll call the listing agent, so that we can do everything in our power to potentially get your borrowers to the top of that list, of offers. And so that is what I would, we're saying that a lot right now, is let us do, it's so competitive. So let us do everything that we have, everything in our wheelhouse to help your borrowers out.
Beautiful. Okay, guys, let's open it up for a minute or two for questions if you'd like.
I have a question. Can you just go over real quick if there's any limits on what's the max amount for some of these loans?
Yeah, so max amount, and I don't have them in front of me, but the new conventional loan amount came out, and I believe it jumped up. It was the biggest 1-year jump to like 648,000, 648,250, I believe. And so, just a huge jump. FHA just came out, and honestly, Ryan, I don't.
I'm looking it up. I'm looking it up.
Yeah, Bill. Sorry, I was in the car and don't have that in front of me.
So
they all have,
conventional max is 647,200.
Yep.
And remember, that's the loan amount. So if they're putting down 20%,
correct,
then they could borrow, they could have a purchase price of, almost 800, for example.
Yeah. So yeah, if they bought a $2 million house, it could still go conventional. It just depends on how much they're willing to put down.
Okay. And then FHA.
I believe it's in the 500 ranges.
All right, keep going. It's not on the first place I looked. Ryan, did that answer your question?
Yeah, I just was curious with all of those though, because that's where I'm sometimes not sure. I mean, I know I've seen the stuff about the conventional going up, but yeah, like VA, FHA, are there any other?
Yeah, no, so and again, that's something we're doing, and when we're pre-approving these borrowers, we're saying, hey, Ryan, so-and-so's pre-approved, conventional, they might have maxed out at the 647,200 mark. We're saying, we're going to tell you as well as the borrower, hey, if you want to go up any more in sales price with the down payment that you're willing and able to make, you're going to jump above that max loan amount. And now your options are going jumbo, a jumbo loan, or putting more down to stay within that conventional loan amount. So we're having that discussion as well, saying, and sometimes we have people, they didn't want to pull money out of their, 401k, but they did to stay below that conventional loan amount to get the better rate, to get, the ease of not having to go jumbo. So we're having that discussion as well. But Ryan, we have all those, new loan amounts just came out. That will be actually something I'm going to make a note to share that at team meeting today.
Okay.
And we have flyers as well. So all that will be available.
Okay, yeah, no, I didn't know if like with the conventional loan, if that changes the FHA loan or any of the others, or like how that all, I just
Yeah,
kind
so
of.
they're all independent. Yeah, each one is independent. They don't, it's not just one thing that changes. The conventional loan amount changes, the FHA changes, and the VA. They're all separate. And
Aren't some of those separate by like lender, or is it all standard?
no, so FHA, VA are set. Government loans. Conventional.
Everybody has the
Fannie Mae.
same limit.
Yeah, all lenders,
Okay.
all banks, same loan amount. Correct.
Okay.
Although does it seem to change by county slightly?
Conventional does not.
No, FHA, I mean.
FHA, it can change per county. Most counties are going to be the same, but there are a handful out there that are considered higher loan amount areas that might be a little bit higher or a tad bit lower. But generally they all do fall, in that same range.
I think I'm looking at the right thing. It says 412,850.
412,850. Potentially, again, sorry, but I don't have it in front of me.
We'll share that number with you guys during team meeting.
Yeah.
But Ryan, a good like those types of questions are going to generally indicate, somebody that has how do I want to say this? Somebody that's got some money, right? And if somebody's got some money, they've probably got a lot of different things going on. And that's exactly why they need somebody like Alec or Kathy in their corner, because that could be, it's not more complicated of a file. It's just they have more things that they need to think about, right? Mm-hmm. So for example, let's say that somebody has what equates to 13% down payment. There's not a difference in PMI change between, let's say, 10 and 13% down. So it doesn't make, in my personal opinion, it doesn't make any sense to put down 13%. It makes more sense to put down 10%, borrow the other 3% at the lowest rate that humankind has ever seen, basically.
And so and to go off that, Bill, every $1,000 you go down or up in loan amount, you're changing $5 in payment. So to your point, Bill, is $15 a month to put an additional 3% down worth it? Probably not. Most of the times it's not.
Yeah. The question becomes, is, do you want to take cash in its most liquid form and put it into the house, which is basically its most non-liquid form, right? Mm-hmm. Remember, the average person has not as much financial intelligence as you would expect them to have, right? And so they really need somebody, again, like Shelter, to coach them through these what is ultimately a very big decision, right? Same kind of concept. If you got 25% to put down, and why would you do that instead of putting down 20%? Just keep the cash. Mm-hmm. Assuming you can afford to borrow the extra 5%, that money is going to be a lot more powerful when it's liquid than when it's not liquid.
Yeah.
Especially if somebody's got to like do renovations and these kind of things.
Yeah.
All right. Thank you, sir. As always, Alec and Kathy and the team are available for the specific questions. If you want more of this type of information, feel free to reach out to them in person or on the phone, and they'll be more than happy to help you. Let me just double check this one question. So that's exactly right, Lisa. Exactly. Due diligence, financing, and appraisal. Okay, let's do real quickly around the room. What is your one thing for today? Alec, I'm going to start with you. What is the one thing you've got to do today for your business to move forward? What is your top priority today?
My top priority today is I have Tuesdays are my team meet, obviously our team meeting day. So, some value add for you guys. And then I am back to back with my pre-quals, getting those, having those phone calls done and getting ready to move towards pre-approval.
Beautiful. Thanks for being here today.
Yeah,
Alexis, what's your one thing for today?
To get on a call with you.
All right. Okay. Well, you got like 2 hours before that. So let's make some calls to your database and let's make some things happen before we talk. Lorinda, what is your one thing for today? What is your top priority? All right, we'll come back. Tracy. Don't hear you. You're on mute. All right, we'll come back to you too. Candace, what's your number one priority? What? You need a second?
10
Okay.
coaching calls. I couldn't get off mute. 10 coaching calls.
10 coaching calls. All right. Ryan, what's your one priority for today?
I have a bunch of people I still trying to follow up with from this open house over the weekend. So that's I'm definitely trying to do all that. The ones that I've finally translated their information.
All right. Remember,
Their chicken scratch.
sometimes if you have, a couple of pieces of information, then you can get some other types of information like.
Well, that's what I did yesterday. Like yesterday evening, it was like a puzzle. But yes, it was like, okay, I got the phone number or I have the address, but I can't read their name or, whatever. So I think I've got it all figured out, but two.
Okay, so we use my assistant and I use a piece of software where if we have the name and the mailing address, we can oftentimes find the telephone number. So if you're having trouble, just send it to me and I'll see what I can do to find it, okay?
Okay, thanks.
That goes for any of you anytime. Lorinda, what is your one thing for today?
It's a twofold. So my first thing is to finish up Bold, to finish it hard. So I have several missing pieces that I need to work on Bold. And then yesterday I ran into a former client who told me now is the time he's ready to buy. So we're going to have our buyer's presentation later this afternoon. So I can find out exactly what he's looking for now, because it's been about 18 months since he mentioned he wanted to first buy in the area.
Awesome. Great job. Great job. All right, Michael, what is your number one priority for today, sir?
Lead gen and getting a plan in place for lead gen.
Great. Okay. Welcome back. Tracy, what is your number one priority for today? For some reason, I think you're frozen. Did I catch everybody? Candace, what's yours? Oh, you already told me. My number one priority today is I'm going to set 2 appointments, and I am back to back almost every minute of the day. So I'm going to
Tracy's back. I can see her blink. I can see Tracy blink. Yeah, I can see her blinking.
All right, Tracy, what you up to today?
Unmute.
No. Well, send your one thing in the WhatsApp so everyone hears you and you can feel like you're being accountable. Okay. I appreciate everyone being on today. Don't forget the team meeting is digital only. Joanne Curtin, who is our number one agent, MREA team, is going to be running the meeting and sharing plenty of tips and strategies. So I got to tell you, if I was in the business, I'll be there anyway, but if I was in the business and the number one agent in our office who is going to make probably $1.5 million this year in GCI, like in earnings and income, was on giving me advice for an hour, I would be there. So that's from 11 to 12 o'clock today. I will see you soon.